Okay, I think I'm going to start. So thank you everyone for joining. Welcome to our Deloitte Debrief Tax webcast series in Asia Pacific. Our webcast today is from our Geography Updates series, and it is titled US 2024 Election Forecast, What to Expect. So my name is Pierre-Henry Rivault. I am a tax principal based in New York in the US. I'm the leader of our inbound tax practice, which is a group of tax experts specializing in serving multinationals from outside the US, having operations in the US. And I have the pleasure of being your host for today's webcast. We have one special speaker with us today. His name is Jeff Comer. Jeff is a tax director within Deloitte Tax LLP in the US. And if you want to know more about Jeff and myself, you may access our bios on the left side of your screen, actually. But before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First, please be aware that all users are on a listen-only mode. So if you have any content-related questions, you can submit at any time in the Q&A box at the bottom right of the screen. And we'll do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, mobile device users can view the slides and answer the survey on their screen. Thirdly, if you require an attendance record for this event, you will receive an automated email with CPE certificates after watching for 50 minutes. So with that being said, we should go to the agenda for today's presentation. And it's easy. I mean, I think the title says it by itself, US 2024 election forecast, what to expect. We will talk about the current situation, and Jeff will tell us what it is. We'll talk about tax policy for 2024, all the constraints, budget deficits, election calendar, future tax policy decisions, and then we will end up with questions and answers. So with that being said, Jeff, I will let you lead our audience to, once again, US tax election, what to expect.
Thank you, Pierre-Henri. It's nice to have a chance to chat with you all this morning for you, this evening for Pierre and Henri on the East Coast here. And I think you're right. The title does lay it out, I think, appropriately. I might just add that it's really tax that we're focused on, right? And it's tax policy, perhaps a little bit more than election forecast. I can go through various different states and different leads that Vice President Harris or leads that former President Trump may have in these elections. But really, my focus at Deloitte is what's happening around the tax legislative process and tax policy, thinking in terms of inbound companies and how that may affect operations that occur in the U.S., employees that may be here in the U.S. And so that's largely going to be the context for the conversation today. And before we really dig into this a little bit, I might frame the discussion just a little bit. And what I mean by that is that really the discussion that we're having is both a current tax policy conversation, but it's also even more significantly about tax developments that are awaiting to occur in 2025. And what I mean by that is that there are some tax proposals that would impact inbound companies that have been pending in the House and ultimately were not taken up by the US Senate earlier this summer. And those are being layered over into next year, but there's some politics involved there. There's some discussion involved there that's worth digging into because I think it helps sort of frame the debate that we're going to have next year. Then as we look ahead, we have in the US, we have all of this tax policy, which is essentially temporary. We have a number of provisions that affect mostly individual taxpayers that is scheduled to sunset at the end of 2025. And that's going to put tremendous pressure on the political parties that are in control of the House and the Senate and the White House next year in order to address those tax provisions, because they will impact a lot of individual taxpayers, in other words, voters here in the US. And so there's going to be a tremendous amount of focus. And why business has to pay attention is that the business community might be looked at as a way to raise revenues in order to help extend some of this individual tax relief that benefits taxpayers in the context of maybe corporate rate increase, maybe stock excise tax increase under current law. Other changes might be out there. And then don't forget that there are changes that are, again, in the US code today that are scheduled to sunset unless they are changed, that would impact international companies in the sense that our US BEAT regime, that rate increases. Our GILTI rate increases at the end of 2025. The FDII benefit diminishes in value. That deduction diminishes in value at the end of 2025 under current law. So you have all of these international provisions. You have individual provisions, which are important to members of Congress and the White House, and a business environment that may all be impacted as part of a significant tax policy debate going into next year. But the thing we have to remember is that it's very hard to handicap right now what that debate will look like without knowing who will control the House and the Senate and the White House. That will have a significant impact on those discussions. So if that kind of provides a little bit of background, maybe we'll start to go through these slides. And if we turn to the next slide, this again is just setting the stage for where we are today. And if you look at the US House and the US Senate, what you'll notice is that there are very narrow operating margins in those legislative bodies. So at the House of Representatives right now, 435 members total. There's a handful of seats that are currently empty. You have 220 Republicans and 212 Democrats. That means that if legislation is going to pass the House of Representatives, and as we often see in the US House, legislation is done on what we would term a partisan basis. In other words, the majority party dictates what legislation is voted on and what can ultimately pass. It means that the Speaker of the House, Mike Johnson, Representative Mike Johnson, he can only afford to lose a couple of votes within his own Republican caucus and still pass that bill on the House floor. And it would be easy if you could simply say there are two political parties and they always vote the same way, in the sense that Democrats will all vote one way and all Republicans will all vote a way. But that's not the reality, right? So the Republican caucus in the House has a number of different factions within it. Same thing with the Democratic caucus. Makes it very difficult to pass legislation in the House on a single party vote. All these different groups have differing opinions on legislation that's coming to the House floor for consideration. You go over to the Senate side, and it's the same thing. You have 51 Democrats and 49 Republicans currently. But remember, procedurally, typically you need to attain a 60 vote out of 100 vote threshold in order to bring legislation onto the Senate floor and ultimately vote on it. There are a few exceptions to that. But for the most part, if you're going to see legislation voted on the Senate floor, it has to reach a minimum of a 60 vote threshold to be considered, which means, as we look at this current ratio, any legislation that's going to pass the Senate really needs to be bipartisan in some form. It needs, even if all 51 Democrats, for example, were to vote for something, it would need a minimum of 9 Republicans to join with those 51 Democrats in order to get to that 60 vote threshold. So Senate's a little bit different, operates a little bit different than the House. The House is much more of a simple majority body. The Senate, you need to have a little bit of input from both political parties. Now, there are some exceptions to that that I'll get into in a minute, including a key one that's important to the tax policy process. But generally speaking, as we look at the current Congress, what we see are two legislative bodies that have very narrow majorities. And as we look ahead to the elections this November, which September 5th, where you are, that's 61 days away from today, what we can anticipate is, regardless of which political party controls the House and the Senate, these narrow majorities are going to continue to exist. And so it's going to affect the legislative process, tax legislation, as we go into 2025. So just to kind of give us a little bit of a background for the political landscape, now we can kind of walk into the tax discussion if we turn to the next slide. And then maybe there's, yeah, Henry,
maybe,
please go ahead.
Yeah, actually, I have a question on this. Situation where Democrats and Republicans needs to agree on something to make it happen. We saw recently the House overwhelmingly approve a bipartisan tax package early this year, actually, addressing important topics like research costs, interest deductibility, bonus depreciation. That said, after the House voted it, the Senate failed to move on it. Where do those proposals stand going forward, and what are the chances, to see legislative activity prior to year end? Someone like me would think if everybody agrees on something, it has to become legislation. Is that that simple?
I wish it were, but you raise an excellent point, Pierre-Henri, and we can actually turn to the next slide because that will start to frame up the answer to your question, which is, to your point, there was legislation that passed the House back on January 31st that would address a number of outstanding business provisions that have been impacting companies. There's really three that we focus on the most. The first one deals with the tax treatment of research costs. The fact that companies have to capitalize and amortize those research costs under Section 174 over 5 years if it's domestic R&D activity, or 15 years if it's offshore or foreign R&D activity, as opposed to the prior law, which allowed you to essentially expense those costs in the year that the cost is incurred. Then you have stricter limitations around interest deductibility. The fact that depreciation and amortization have been removed from EBIT calculations. And so you don't get that additional D&A as part of that calculation. And then bonus depreciation. It was 100% immediate write-off. Then it was 80% last year. It's 60% this year. Next year, it's supposed to be 40% under current law. And in a couple of years, it will actually phase down to zero unless there is a change between now and then. And to give you a little idea of how long we've had some form of write-off for CapEx projects in the tax code, it goes back to 2008 that we've had some form of bonus depreciation. So it's been a long time that we've had that in the tax code, and that would, under current law, ultimately schedule down and phase out in a couple of years. And so there was a lot of legislative activity around trying to address those three business provisions between Republicans and Democrats. And for a long time, there was a debate where congressional Democrats reminded congressional Republicans that these three business tax increases were enacted in 2017 as part of the tax law called the Tax Cuts and Jobs Act, which was passed and approved and signed into law by former President Trump, approved by a Republican-only Congress, Republican-only House and Senate. No congressional Democrats voted for it. And so congressional Democrats said, look, we are okay with making these changes that would benefit business. We're for business too, but we want some changes to sort of to offset the fact that we're voting for this. And so they looked for changes related to the child tax credit. That whole conversation kind of came to a standstill for a while. And then earlier this year in January, there was a deal brokered and released between Senator Ron Wyden, who is the Democratic senator who is chair of the Senate Finance Committee, and then Congressman Jason Smith, the Republican chair of the House Ways and Means Committee. So you had the top Republican tax writer in the House, the top Democratic tax writer in the Senate, and they put this deal that's on this slide here, and it does address those three business provisions mostly. I would say mostly. It does address research costs. It goes back to expensing, but it does not fix the international component. It's only domestic R&D, and it's retroactive. So for R&D and your stricter deduction limitation cost provision, those became effective in 2022, and this would go back to January 1, 2022. Bonus depreciation would go back to 100% effective retroactively back to 2023. So it does address those business provisions. This deal also has some modifications to the child tax credit. So it made congressional Democrats comfortable with that. And then there's also provisions in here to create essentially a parallel tax treaty for the U.S. and Taiwan. U.S. has a two-China policy. And so because of that, we don't have a tax treaty with Taiwan. This would use the tax code to effectively create a structure similar to a tax treaty in order to mitigate those withholding tax issues. And this is primarily arising out of the U.S. CHIPS legislation, which is designed to incentivize companies, a lot of Taiwanese companies, to come into the U.S. And start to invest in chip fabrication plants here. So that legislation is in there as well. And all of this came together. And as Pierre-Henri noted, the vote back on January 31st in the House was 357 to 70. So it had members of both the Republican and Democratic Party. It felt like it had a lot of bipartisan support, a significant majority. And we all thought it would go over to the Senate and be voted on immediately. And yet here we are in September, and the legislation has not passed, and it's not going to get voted on in the near term, in the next couple of months for sure at this point. And so the question becomes, why did that happen? Well, this is where sometimes good policy is overrun by politics and personalities. And so what you have is, again, the support of the top Democratic tax writer in the Senate and the top Republican tax writer in the House. But what we typically look for bipartisan tax legislation is what we call a four corners agreement. And what we mean by that is that not only do you have the top Republican, the chairman of the House Ways and Means Committee, but you also have the ranking Democrat on that committee in support. And then you have the chair of the Senate Finance Committee, but you also have the ranking Republican in support of that bill. When the top tax writers in both political parties and in both legislative chambers is in favor of something, it makes it very easy for the Speaker of the House and the Senate Majority Leader to just schedule that legislation for a vote on their respective floors and send that bill to the president. But this legislation did not have that four corners agreement. It was missing essentially one corner, and that is the top Republican tax writer in the Senate, Senator Crapo from Idaho. He came out immediately after the House passed this bill and said, I have some real concerns with this, concerns with the structure of the changes to the child tax credit. He also said that the fact that this bill is paid for, because there are some changes to a U.S. program that goes back to the pandemic called the Employee Retention Tax Credit. It essentially closes that down. There's been a lot of debate here in the U.S. The IRS isn't even processing claims anymore for this credit because there's been a lot of fraud, waste, and abuse associated with it. So it closes that credit down essentially, and that would raise about $78 billion over 10 years. That's the score. The rest of these tax relief provisions would cost about $78 billion over 10 years. So it's essentially a revenue neutral tax bill. Senator Crapo, as the ranking Republican on the Senate Finance Committee, said that he is opposed, not because he's opposed to changing the Employee Retention Tax Credit program, but he's opposed on principle to the fact that the bill is paid for. And why that's relevant is that Republicans generally have a history that says if you are making tax law changes that affect current law, thinking in terms of 174, 163J bonus depreciation, if you're making those changes, then you don't have to come up with either tax increases or spending cuts to offset the cost of that legislation. You can just kind of add it to the deficit and move on, essentially. So the reason why Senator Crapo is opposed to this bill being paid for is not because it's a $78 billion tax bill. He's looking ahead to the future because I mentioned 2025 is going to be a big year for tax policy. When we start looking at the cost of all of those provisions that are scheduled to sunset, and if we were to try to extend all of those provisions into the future, the cost is closer to $4.5 trillion, not $78 billion. Senator Crapo also is looking at the Senate electoral map, which we'll talk about in a bit, and it is predisposed to favor Republicans in these Senate races. So there is a chance that he will be chair of the Senate Finance Committee next year. And if he is, he doesn't want to find himself sort of painted into a corner where someone comes back and says, well, hey, wait a minute, you voted for that tax bill last year that was paid for, so why don't you pay for all of this stuff too? Doesn't want to find himself kind of, have his negotiating authority or his leverage, if you will, limited by that. And so he's opposed to this legislation for that as well. So now you have varying different reasons. And then you also have the fact that Senator Crapo and other Republicans are looking at that Senate map. They think that if they're going to be in charge next year, they can perhaps negotiate a better deal as part of this larger tax discussion. You also just have politics. It's the simple fact that a lot of Senate Republicans don't want to give the White House a legislative win, when we're only 61 days away from November 5th. And so where we end up on this, sort of long-winded answer to Pierre Henry's question is, you have legislation that is bipartisan support. It should have passed the Senate, but it didn't. It's now going to layer over into the larger tax debate along with everything else next year. And the primary reason it didn't pass really is simply because it's an election year, and everyone is focused on what will happen next year. Nobody wants to give anyone any sort of ability to claim a win. They would rather wait until next year to take this up. So this legislation, unfortunately, should have happened. It would help companies significantly if it did. But now we're going to have to wait as part of a larger debate in 2025. If we turn to the next slide, a couple of other topics just to touch on here. Pillar 2, a lot of discussion around Pillar 2. Now, of course, I am not a Pillar 2 person here at Deloitte. I focus more on how Congress is reacting to all of this. And again, what you see is a differing discussion depending on whether or not it's Republicans or Democrats. You saw a Biden White House, for example, as well as congressional Democrats talk about increasing the U.S. GILTI rate to 15%, as well as requiring country-by-country reporting. And those would be, the OECD effectively said those changes would be suitable to consider the U.S. as conformed to this 15% minimum tax regime under Pillar 2. Congressional Republicans are not happy with that. They don't like the way Treasury Secretary Yellen and the U.S. Treasury Department negotiated the OECD around Pillar 2 without acknowledging that Congress would ultimately have to pass legislation to enact these changes in order for the U.S. to be part of this larger Pillar 2 discussion. So they feel like they were a little bit left out of the process, and they're not very happy with that. Then there's also a discussion around U.S. tax credits that is pretty significant. The fact that significant business tax credits like the R&D credit and others essentially count as a tax expense for that minimum tax regime calculation. It's essentially pushing U.S. multinational rates down below 15% further, allowing those jurisdictions to impose and collect and assess that top-up tax to get to 15%. And they look around the world at the UK and other countries that negotiated perhaps a little bit better. And their R&D regimes are treated a little bit differently. And so they're not happy about that. So where are we today? Where we are is that as of now, the U.S. is not conformed to this Pillar 2 regime. A lot of this will depend on the elections. If Republicans are in charge next year, maybe that means that the U.S. will continue to not be part of this tax discussion. And in fact, the U.S. might start to retaliate through the tax code by enacting legislation that will go after countries that begin to assess that minimum tax and collect those top-up taxes. Using the tax code to battle, if you will, other countries, maybe by going after foreign-owned companies and foreign individuals that are domiciled in countries that impose an undertaxed profits rule and collect the top-up tax. They might retaliate with increased beat rates or something like that. Those are all ideas that are on the table. So this issue is left open at this point. A lot of it will depend, I think, on the outcome of those November elections. Excuse me. If we turn to the next slide. Again, this is just kind of noting that the IRS here in the U.S. has been very busy. They have an additional tranche of funding that they're working with. It originally was $80 billion over 10 years. Now it's about $60 billion because some of that's been rescinded and carved back. And to put that into context, by the way, the amount of financing or funding that the IRS received for this year is $12.3 billion. So you think about 60 roughly over 10, maybe an additional 6 or so billion a year. So, roughly an $18 billion budget rather than a $12 billion budget. But what we do know is that the service is very busy. They're very focused on increasing audit activity, audit rates, audit scrutiny related to 3 primary areas. It's large multinational companies, it's ultra high net worth individuals, and then sophisticated pass-through entities. So they're looking at global law firms, hedge funds, large multinational real estate operations, those big sophisticated pass-through entities with thousands of K1s. They're starting to dig into those and try to determine whether there are additional revenues that can be found by increasing their audit activity. So they put out a revised report back in April that essentially says by the year 2026, they're going to ramp up their audit rates in those 3 major areas fairly significantly. Does this mean that suddenly the IRS is sort of has the tools and the personnel to really increase audit activity in a lot of areas? I don't think we're there yet, but I think directionally, this is an area this is something we need to kind of pay attention to. We can anticipate that the service here in the US is going to be busy, particularly in these 3 spaces, and that they're going to be looking to utilize new technology platforms, a lot of discussion around utilizing data analytics, looking at AI applications, as well as new technology platforms in order to increase the sort of scope and scale of what the IRS is doing. So just be mindful that this is sitting out there, and we might see more developments in this space in the future. If we turn to the next slide.
That's me again, Jeff. Yeah, I'm sure the audience, might be wondering, everybody follows, the announcement made by the government. And of course, we notice that there are a lot of business tax increases, which are included in the President Biden's budget for this year. What do you think will happen about those tax proposals in the president budget if, for whatever reason, if the Republican control the House after the election? Do you think it has a chance to survive?
Mm-hmm. Yeah, so that's a good question. And as I look at these business tax increases that are part of the president's budget, and again, to put a little bit of background to that, every year a White House has to submit a budget to Capitol Hill. It's usually done the first Monday in February, but in recent years, we've seen that date move around a little bit. So this year it was March 11th when that budget submission was sent to Capitol Hill. And then to accompany that, the U.S. Treasury Department produces a book called the Green Book. And it is a brief description of all the tax proposals that are in that budgetary request that goes to Congress. Now, just because a White House submits a budget doesn't mean that Congress immediately begins to act on those things. But we do look at a handful that are on this slide here and ask the question, if congressional Democrats are interested perhaps in some of these, and the White House has proposed these, as we think about election outcomes, if Democrats were to control the House and the Senate and Vice President Harris wins a term election, and you have an all Democratic Washington next year, essentially, are some of these possibly on the table for discussion? I think the short answer is yes. But typically, historically, Republicans have tended to focus more on spending cuts than on tax increases. So as we look at this same list, what if we project ahead to next year and say Republicans control the House and or the Senate and the White House? Does that mean automatically that none of these are going to be considered? See, I think 2025 is going to be a little bit different. I mentioned earlier that we're talking about a cost in the $4.5 trillion range. It's going to be very hard to just add $4.5 trillion to a federal deficit, an annual deficit, especially when you have long-term debt picture in the US looking the way it is now. So does that mean that all of these, that congressional Republicans would suddenly vote to increase the corporate rate to 28% here in the US from 21%? No, I don't think so. But could they get comfortable with a higher rate? 24%, 25%, maybe. Some of these other changes, like the excise tax on stock repurchases, is at 1%. Could it go to 4%? I don't think so. But could it move to 2%? Possibly. Some of these other changes could happen as well, simply because there's going to be a look to try to find revenues in order to extend a bulk, if not all of that, of those tax provisions that are scheduled to sunset at the end of next year. So suddenly it puts the business community on notice that there could be tax increases sitting out there on the horizon to think about. Another one on here is increasing the relatively new, the book min tax, the CAMT, from 15% to 21%. Again, I don't know if I really see that going to 21%, but could it possibly bump up to 17, 18%? That may be a possibility. Again, there's going to be a lot of hunting around potentially for revenues next year, and looking at large multinational companies, inbound companies, as part of that discussion. You're going to be potentially targeted as being looked at for ways to find revenue, again, to address some of these other tax issues that are going to be on the table. So it's a very good question, Pierre-Henri. But this is just a sampling of what we might see come up for consideration next year. If we turn to the next slide, I think we get into our next section here. And maybe we'll turn one more slide. And this is a little bit of the spending discussion that we're having here in the US. And why I think it's kind of relevant is think about the US government as outlays, spending, and revenues, and that's tax. And if you kind of get a feel for the outlays and where those outlays are, then we kind of understand the revenues discussion a little bit more perhaps as well. So I like this slide. These are charts put together by the Congressional Budget Office. It's the nonpartisan budget office that Congress has to use when they do spending and large revenue estimates. And so what this shows us is certainly how government spending has grown since 1962. But I focus really on the bottom two charts, and that's 2021. And what you'll see there is that 71% of government outlays in 2021 was allocated to what we call mandatory spending programs. That is Social Security, that's Medicare, Medicaid, that's Aid for Needy Families, TANF, SCHIP, Aid for Children. Those are programs that nobody in Washington is really talking about changing in the near term. And yet over 70% of the total government outlays in 2021 were allocated to those programs. Then you look at the fact that we had about 5% was really just our annual debt service cost, our debt payments on our deficit. And that was about 5% of the total pie, if you will. And then all of your spending, all of your defense, US defense spending, as well as non-defense domestic spending was about 24%. So the reason why I kind of find this chart interesting is that there is no lack of congressional members or candidates, White House candidates, who talk about how they can solve things in Washington if only we cut spending. You'll hear that often enough. Well, and congressional Republicans, they might say, if you only cut domestic non-defense spending, we could solve a lot of our fiscal issues. And you might hear congressional Democrats say, well, if we only cut defense, we could solve a lot of our fiscal issues. But as we look at this chart, the reality is that even if you cut significantly both defense and non-defense spending, you're still only impacting a narrow slice of the overall government spending pie. So because the reality is that most of your money is really being spent in programs that nobody's talking about trying to address in any significant way. Then you fast forward the right one to 2034. And again, these are CBO projections into the future. And the first thing you'll notice is that mandatory slice of the pie is a smaller slice. It's only 63% versus 71%. But when you look in terms of real dollars, the projection in that year is that the US will spend $6.3 trillion just on those mandatory programs. That's $1.5 trillion more than they spent in 2021. So it's not that suddenly that amount of spending goes down. It's that our debt service cost, with an increased interest rate environment that we operate in now, soaks up a larger slice of the pie. So now we're paying much more. We're paying more projected in 2034 to service our debt than we're spending on all defense programs or all non-defense domestic programs. And then you still end up with now about 21% of the pie is left for all of those other things. So my only caution here is that as we hear politicians talk about solving fiscal problems by cutting spending, the short answer is yes, you can cut spending. You could come up with $150 billion. I could sit here with a piece of paper and probably jot out $150 billion worth of program savings. And that's a huge amount of money. But when you're talking about a federal government that in 2023 spent $6.2 trillion and brought in only $4.4 trillion worth of revenues to offset that, that's actually a fairly small number. And so the challenge is that when you think about the spending discussion, if you decide that fiscally the US should try to figure out a way to narrow the gap between 6.2 trillion and 4.4 trillion in a given year, if you can't lower the spending line down, then by definition, we start having a discussion around increasing the revenue line. And so as you think about as a percentage of GDP in the US, federal government is projected to spend this year about 23.8%. Revenues are about 17.8% of GDP. If you look at those two lines, if you decide that they need to get narrower and you can't lower the spending line, then you end up looking at the revenues line. If we're looking at revenues, we're talking about tax. So it just kind of helps put into context the numbers that the US operates with.
And Jeff, I mean, that's me again. So far, when you look at what has been said by the Republican or the Democrat candidates, there is not a lot of detail on what they will do and their proposed tax policies. Based on history and what's going on in DC, do you expect that we will get more information as we get closer to the election day, or will we have to wait until next year or even after to know?
Yeah, no, it's an excellent question, Pierre-Henri. And I think we are going to see very, very high level details, very limited detail in the tax policy space. I think to date, what we're seeing are two candidates who are looking at different groups of taxpayers and are deciding to try to target them with tax relief. And by doing that, by the way, it also, if they were to actually be enacted, and I'll go through a couple of these notions in a minute, but if they were to be enacted, it would actually make some of these revenue charts look even worse than they do already. But you're absolutely right. As we kind of go into the next couple of slides, we'll dig into this a little bit. If we turn to the next slide, this is looking at Vice President Harris. And as we know, the Vice President has replaced President Biden at the top of the Democratic ticket. And there are not a lot of details, but what you see here are adopting some of the parameters of President Biden, the White House's budgets that they have submitted. So as we dig into, for example, this 2025 discussion around individual taxpayers, the White House has maintained that they would prefer to keep the Tax Cuts and Jobs Act, the TCJA tax provisions intact for individual taxpayers in the U.S. with $400,000 or less of adjusted gross income if they're an individual taxpayer, $450,000 or less if they're a joint filers, married couple. You've now seen the Harris campaign adopt that. So essentially preserving the tax relief for middle and lower income taxpayers while allowing the tax code to revert back to pre-2017 tax law for upper income taxpayers, which would increase their overall tax burden going forward. She also has adopted a 28% corporate rate, which is different because remember, Vice President Harris, if you go back to 2019, she was presidential candidate Harris in the Democratic primary, but going into the 2020 elections. Back then, she'd actually proposed returning the corporate rate to its old 35% rate, up from 21% today. But now she's adopted that Biden White House proposal of 28%. So you see some consistency around tax proposals that have been put forth by the Biden White House over the last couple of years. But you also see some nuanced differences. Vice President Harris has adopted the idea of a tip tax relief in the U.S., which former President Trump was the first to talk about. Very important in the hospitality industry, very much focused on Las Vegas and Nevada in particular, looking at workers here in the U.S. who receive a significant portion of their income via tips and essentially suspending the tax treatment. So they have to pay tax on those tips. That is very popular, right? And thinking in terms of voters, very targeted towards voting blocks that will be very important in the presidential election in November. Nevada, one of those handful of key states, for example. No discussion, however, no details on how that might be paid for. And that might be a very expensive tax relief proposition. The vice president also just today released a couple of other tax proposals related to the expensing of startup costs for companies. So currently, a U.S. company that has startup costs can take 5,000 of those out and deduct those, increasing that to 50,000. And then there's also a tax increase proposal that the Biden White House has that would say if you are a taxpayer making $1 million or more, you're going to pay what we call ordinary tax rates on your long-term capital gains. Right now, long-term capital gains is 20% tax rate. It would move up to 39.6% under the Biden White House proposal. And then there would be an additional 5% related to net investment income tax, so 44% roughly. She has said that she would increase long-term capital gains from 20 to 28% for those taxpayers. Then presuming that there's this net investment income tax, that would be about 33%. What you see are a couple of proposals targeted towards angel investors, entrepreneurs, venture capital, investment management industry. I think that is sort of micro-targeting politically to a key block of voters in the technology space. Former President Trump has been making inroads with a lot of folks in the technology industry. And I think you're seeing a Democratic presidential campaign that is reacting to that. So we expect to see maybe more sort of these targeted tax relief ideas, but not the kind of details that we would need, not the kind of details where you could actually draft it into the tax code, the legislative language. These are very high level, ideas that we're seeing come out of both the vice president's campaign, as well as, if we turn to the next slide, former President Trump's campaign. And what we see here again, former President Trump has talked about lowering the corporate rate even further, going to 20% from 21%, or even 15% possibly. But I'm not convinced that that can happen in the current environment, simply because, again, I hear more and more congressional Republicans who might be comfortable with the rate actually increasing if it means that they can use that revenue to pay for other things that they want to do. So it feels to me like the rate going down is less likely in this conversation than the rate possibly going up. You see, again, the former President Trump was the first to talk about tip tax relief. He's also talking about Social Security taxes in the U.S. And again, targeting different voting blocks that are going to be important in those November elections. I see as what the two candidates are doing in the tax space. If we turn to the next slide, this I think just gets a couple of slides on the House and the Senate, and this really is just pointing out that we have a significant number of both Republicans and Democrats who are not coming back, who are not running for re-election in the House. And you have, and this is particularly important as we think about control of the House next year. I think the current sort of handicapping in Washington right now is that congressional Democrats are positioned to take control of the House. Obviously, a lot can happen between now and November 5th. But right now, the betting, if you will, is that congressional Democrats are positioned to take control of the House. A lot of that has to do with the fact that a number of Republicans have resigned or are running for other office. It also has to do with the fact that there are 17 Republicans in the House who represent congressional districts that in those districts, President Biden won in 2020. So they tend to be a little bit more Democratic leaning. And so perhaps more difficult for a Republican member of the House to retain in the November election. As we turn to the next slide, we look at the Senate. And then again, as I mentioned before, the Senate map today is predisposed to favor Republicans simply because there are more Democratic seats that Democratic incumbents have to defend. And more importantly, there are seats that Democratic incumbents have to defend in Republican states. So the Democratic Senator John Tester from Montana, for example, Montana is a very Republican state. He is a Democratic senator. It's hard to win in a presidential election cycle if you're a Democrat in that state. Senator Sherrod Brown in Ohio is in the same situation. Senator Jackie Rosen in Nevada is in the same situation. And I mentioned before that the ratio today is 51 Democrats and 49 Republicans. But the other thing to remember as we look at this map is that as we look ahead to 2025, the US Senate is already essentially 50-50, at a minimum, 50-50 next year, because Democratic Senator Joe Manchin is retiring from West Virginia. West Virginia is a very Republican state. The Republican governor, Jim Justice, is a very popular governor. He's won the Republican primary already. Barring any huge change in that race, Governor Justice will be sworn in as a Republican senator in West Virginia in January. So already the map is 50-50, which means if former President Trump wins the White House, wins a second term, it means that Republicans would control the Senate in that 50-50 scenario. But there's also Montana, Nevada, even Michigan in some cases, Ohio, other states that could put that in the Republican control side of the ledger in 2025. So it feels, at least as of today, like we might see essentially a flip of what we have now, a Democratic House and a Republican Senate. That's just a little bit of the political backdrop. So now we kind of turn to the next slide. And this is that number that I mentioned earlier. When you start taking into account current law and extending that into the future, current tax law, all of those provisions that impact individual taxpayers, as well as looking at taxation of research costs and bonus depreciation, and then also, this takes into account if you don't increase the GILTI rate and the BEAT rate and diminish the value of the FDII deduction benefit. If you take into account, just extend the law today into the future, the total 10-year cost comes in at about $4.6 trillion. That is a significant amount of money. It's not something that we can simply say, let's just add that to the deficit and move on, particularly given that the U.S. Debt now is the long-term debt's over $33 trillion, and CBO projects that to hit about $52 trillion in the year 2034. We can't just add that to that total amount and not try to offset that in some way. And that's going to put a lot of pressure on policymakers as we go into next year. So if we turn to the next slide, this kind of gets into some of those pressures. So I mentioned, again, a lot of this may not be relevant as you think about an inbound operation here in the US because it's individual focused. But to the extent that business tax increases are brought into the discussion to help pay to extend individual tax relief, it becomes a more important conversation to have. So we have all of these individual provisions, child tax credit. There's also a big one that's important for a lot of members of Congress related to our pass-through entities, and that is 199 Cap A. That would also sunset. The whole point of that 199 Cap A deduction was to provide effective tax rate parity for pass-through business income, because remember, those are businesses where the income ultimately is recognized and taxed at the individual taxpayer level. It was to provide effective tax rate parity with a 21% corporate rate. So we have a tax code today that unless something changes, beginning on January 1 of 2026, the corporate rate would still be 21%, but there would be no 199 Cap A benefit for all those pass-through entities. And while the bulk of business tax revenues come from corporate entities in the US, the number of actual organized business entities, about 93% of all business entities in the US are organized as pass-throughs. So they have a very much of a connection to members of Congress. They're very focused on that. We also have those three business provisions that weren't addressed related to research costs and bonus depreciation, interest deductibility rules. And then don't forget, there's a number of what we call expiring tax provisions that are scheduled to sunset at the end of next year, including work opportunity tax credit. There's some in the economic development space, like empowerment zones, new markets tax credit. Multinationals, there's 954C6 planning, look-through treatment that is scheduled to sunset at the end of next year. So you have all of these things that are all aligning into this huge tax cliff at the end of 2025. And again, hard to handicap how this conversation is going to go without knowing who's in control of what. But we can start to kind of do some scenario planning. So, one thing to think about is just kind of go through different scenarios. One could be that Vice President Harris wins the presidency. Congressional Democrats manage to retain control of the Senate, and they take control of the House. They control all the levers, right? What does this conversation in broad strokes look like? Well, I think it means that there's going to be, an attempt to extend individual tax relief. Again, those taxpayers $400,000 or less, and they're going to bring tax increases onto the table in order to finance that. That's going to mean upper income individuals in the U.S. and businesses potentially as well. What if former President Trump wins a second term, Republicans retain control of the House and they win control of the Senate? There's still going to be, I think, pressure to extend and make permanent TCJA beyond the end of 2025. And that's going to put pressure on some of those permanent provisions in the code, like the corporate rate and the stock repurchase excise tax and others, even on the Republican side of the aisle, to offset the cost of that potentially going forward. And again, we can't dismiss the importance of pass-through businesses here in the U.S. to members of Congress, and the fact that 199 Cap A deduction would sunset. There's going to be a lot of pressure to extend that into the future to keep that parity with the taxation of income from corporate entities. Now, in each of these two scenarios, this discussion only happens, I think, through certain parliamentary methods. And this kind of gets back where I mentioned at the very beginning, this discussion around process and the fact that there are exemptions, if you will, from that 60-vote threshold in the Senate. There's a very valuable process in the tax space called budget reconciliation. It essentially allows the majority party to ignore the minority party and pass what they want in the tax space. And they only need a simple majority vote in the Senate, provided they adhere to a pretty strict set of rules that govern that budget reconciliation process. And so we saw Republicans use this process in 2017 to pass the Tax Cuts and Jobs Act. We saw Democrats use it in 2022 to pass the Inflation Reduction Act, all of the clean energy incentives, for example, that were part of that. Expect that if we have unified control in either party, expect them to utilize that process in order to pass tax legislation next year. A third scenario, what if we have divided government? Well, all of this gets more difficult in the sense that both parties are going to come at this TCJA sunset discussion from different perspectives, and it's going to be hard to negotiate and walk through and come up with a compromise, but that's what they'll ultimately have to do. So divided government makes, I think, this whole discussion more challenging. What if a fourth scenario occurs? What if we just can't get it done by the end of 2025? Could it be delayed? We do have a precedence for this. If you go back to 2010, there were a number of individual tax provisions, rates, things like that, that all were scheduled to sunset. And there was a deal to extend all of those provisions for 2 years through the end of 2012. Could that happen? Yes, it could. But I think TCJA is a little different than what we refer to as those Bush era tax cuts from 2001. That was all tax relief back then. Here, TCJA is actually an interrelated set of tax increases and tax cuts. While it is a net $1.5 trillion tax cut over 10 years, it's actually about $4 trillion worth of tax increases and $5.5 trillion worth of tax cuts. So you're going to see members of Congress, for example, focused on, again, maybe more individual things in the U.S., limitations around mortgage interest deductibility, state and local tax deductibility limitations. And they're going to say, I think, we don't want to see the bad things also extended for 2 more years. If it was just tax relief, that'd be one thing. But if there's things we don't want that are also extended for 2 more years, then maybe that's not the outcome that potentially we're looking for. So as a business, as you look at this sort of U.S. discussion that we're having, couple of observations to kind of close the tax policy talk with. Number one, be prepared for this to be more than just a discussion related to TCJA. I think there's all sorts of tax increase as well as tax benefit ideas that could end up being thrown onto the table for consideration. In other words, I don't view this as, if you just change one provision in TCJA to pay to extend another provision in TCJA, that's where it's going to be bigger than that, right? So that's why we have to pay attention to things like corporate rate and changes in the international space, and other perhaps targeted limitations on inbound companies in order to raise revenue. I think we have to think about this as much broader than just what's in TCJA today and deciding whether or not to extend that. Which I think brings me to the second point, which is the business community needs to be more prepared to play defense this time around. In 2017, everybody in Washington agreed that a 35% corporate statutory rate was too high. There was a differing of opinion as to where that rate should be, but everyone agreed it was too high. That wasn't the issue. International tax rules, whether we like GILTI and BEAT and FDII or not, the old set of rules, everyone agreed needed to be changed in some form. The US had all of these companies with all of these trapped earnings overseas, some sort of one-time repatriation mechanism to tax those going on, so that they could be tax-free then on a go-forward basis. There was all of these different concepts that were talked about. International needed to be changed. It's different this time because now we're talking largely about individual tax relief, and members of Congress will be looking to make voters happy, essentially. So that means that the business community has to be prepared, I think, for defending what you have in the tax code today, as opposed to just waiting around for tax benefits to land in your lap that you can take advantage of in the future. And then a third observation is to watch timing on this. All of this is scheduled to sunset at the end of 2025. But again, there's a very real chance that we get to January 1 of 2026 and TCJA sunsets, at least temporarily. And maybe it's because tax writers in Washington will say, we're going to get a deal done and we'll make it retroactive back to January 1 of 2026, but we're just not done yet. And so you're going to have this gap, and it's going to create crazy uncertainty and questions. Again, if the corporate rate is 21%, but pass-through businesses don't have that deduction to provide that effective tax rate parity, does that mean that U.S. pass-through owners all run out and get into C form? They become corporate entities? I'm not sure, because you don't know if the end of that discussion, whether there will be a deduction again for pass-through business income, and whether the corporate rate will be at 21% or 24 or 25 or some other number. So it's hard to project into the future, but we could have a very uncertain tax code if they're not all done by the end of 2025. And everybody in Washington just says, well, we'll get it done and it'll be retroactive back to January 1 when we do. It's going to create a lot of planning uncertainty and questions, I think, in the tax departments going forward. So some observations to think about going forward. We have one last slide that we'll touch on here. I think Pierre-Henri will turn to the next slide. Yeah, and this is just sort of ending on election outcomes. What do we know about November 5th? I think the answer is that we don't yet know who will win because the polling is so close right now. But what we do know is that it will come down to essentially a handful of votes in a handful of states. You can't look to history to predict the future. But what we do know is the last two presidential elections were very narrow. In 2016, former President Trump beat former Secretary of State Clinton by winning 3 states that were key to the U.S. Electoral College map. And that was Pennsylvania, Wisconsin, and Michigan. Combined, it was about 78,000 votes out of about 133 million votes cast in the election. In those 3 states, delivered them to former President Trump, and that put him over the 270 Electoral College votes that he needed to win the White House. You fast forward to 2020, and it was 3 states again. This time it was Georgia, Arizona, and then again Wisconsin. President Biden won those 3 states, 45,000 votes across 3 states in an election where 158 million plus votes were cast, ultimately determined the Electoral College map and put that in President Biden's favor. As we look ahead to November 5th, we know that, again, it's Arizona, particularly Georgia and Pennsylvania, Arizona, Georgia, Michigan, Pennsylvania, Wisconsin, maybe throw Nevada, maybe put North Carolina in there as well. But it's all going to come down to relatively few votes. Again, 45,000 out of 158 million, that's 0.00001%. It's going to come down to, I think, relatively a few number of votes in a handful of states are going to determine who is in the White House beginning on January 20th, Inauguration Day of 2025. So very interesting. With that, I'm happy to turn it back to you, Pierre-Henri, to close us out.
Thank you. I mean, this is unfortunately, all we have for the time we have. So thank you, Jeff, for a very good presentation. Thank you all for joining. Glad you were able to join us. So we encourage you to fill out the short survey that will pop up on your screen momentarily and tell us what you think about today's program. If you join us late, please know that this presentation will be archived for future viewing. So if you feel that others would benefit from this webcast, please share the webcast via the share this icon then visit the Debrief website. We will respond to all questions submitted during the webcast in a couple of weeks. And also, if you think any other questions or comments, if you think of any other questions or comments later, please feel free to reach out to either me or Jeff, and we will be more than happy to discuss with you. And please don't forget to tune into our next scheduled webcast it will be on indirect tax on September 17th. So as part of all of us at Deloitte, thank you very much for your participation in today's Deloitte Asia Pacific Tax webcast. Have a good rest of the day. Thank you again, Jeff. Talk to you soon. Bye, everyone.